An important concept to understand when we talk about cost of capital is a firm's capital structure, and that's basically the firm's mix of debt and equity. So it captures where the holdings of the investor groups that provided the firm with the funds to acquire assets, develop those assets, maintain those assets, grow those assets, and as a result of being the ones who put the money in the firm in order to basically get the claims on those assets, they have the claims on the cash flows produced by those assets. So they're the ones that put the money in so the firm could get the assets and maintain them. So as a result, the cash flows that are produced by those assets, once employees and suppliers and taxes are paid, whatever's left over, the folks that hold the investments, the folks that own the debt and own the equity, they have the claims. There's a lot of different types of debt and equity that are used by firms. The main ones for corporations are bonds and common stock. Bank loans are often used as well. Preferred stock to a lesser extent than common stock, but those are some of the main ones, especially bonds and common stock. So, in our analysis, we're really going to rely heavily on the balance sheet. And the left hand side of the balance sheet is equal to assets. And so you've got your balance sheet, and over here you've got assets. And what goes on the right hand side of the balance sheet? Well, we're going to make a common assumption that on that right hand side, normally it's liabilities and equity, but we're going to assume that the only liability that we're paying attention to and that exists is long term debt and equity. And so, therefore, when we talk about debt in our cost of capital analysis, we're talking about long term debt. And as a result, we have our balance sheet equation assets equals debt plus equity. And the reason this is important is because we've got a balance sheet that looks like that, assets equals debt plus equity, and it's really difficult to observe the assets of a firm. Take a firm like Starbucks. They operate in many, many countries. They have stores, they have products in uh, retail outlets. They provide coffee to airlines and schools. They have value in just their brand name and logo. There's value in future innovation, and it's really hard to value that, assess the risk of that, and kind of observe it. However, the firm's debt and the firm's equity are much easier to observe. A lot of that is publicly traded, it's just available online. We've talked all semesters about some basic tools in evaluating debt and equity, and as we'll talk about in a minute, specifically, we can look at the debt and equity side of the balance sheet to learn about the asset side of the balance sheet. So, the first thing is we can figure out the market value of the firm's assets if we look at the market value of all of the firm's debt and equity. So again, here's your balance sheet. You've got assets and you've got debt and equity. How do you value Starbucks assets? Stores all over the world, relationships with grocery stores, relationships with airlines and college campuses and employers, the logo. I mean, it's really difficult, but you simply value the debt, you simply value the equity, you add those up, and you get the value of the assets. And again, notice we're talking about market value. So when we're talking about balance sheets that we're really paying attention to, we're talking about market value balance sheets. So we can get the expected return of a firm's assets by looking at the market, the expected return of a firm's debt and the expected return of the firm's equity. That if we had a portfolio and we owned all of a firm's debt and all of a firm's equity, take a look at the expected return of that portfolio, making sure to take into account the fact that there's some tax benefits to debt, we can figure out the expected return of a firm's assets. So again, if you were asked to find the expected return of Starbucks assets, that would be incredibly challenging. They have, by directly looking at the asset side, stores all over the world, relationships with, different kinds of vendors, really hard to assess directly. However, you can find the expected return of the debt, find its yield to maturity, find the expected return of its equity by looking at future growth rates, future expected dividends, betas, doing the kinds of things we've spent time doing and that the field of finance has developed, and you can come up with the expected return of those and use that to figure out the expected return of the firm's assets. A couple of terminology. The term required return, the return required by the investors, is equal to the expected return. So the expected return for debt and equity that we've talked about, if you imagine it from the perspective of the investors, that's the return that they require in order to invest in those securities. They wouldn't require more because they understand how markets work, and for a given level of risk they're not going to get more, and they certainly wouldn't require less because they know how markets work and they know that the expected return is tied in with risk, so they're not going to accept less than they need to. So when we talk about return required return, that is kind of the expected return but viewed from the investor. In order for me to be willing to hold this is the return that I require. From the perspective of the firm, we can look at those expected returns as the cost of debt and the cost of equity. So the expected return on equity is the cost of equity. So the firm has some stock. The expected return is what it needs to produce for its shareholders, or is expected to produce for its shareholders. From the firm's perspective, that can be viewed as a cost in the sense that they need to be able to produce that. Cost of debt, it is the yield to maturity, which is the expected return from the debt holder's perspective, and we can view it as a cost to the firm in the sense that, okay, I've got some assets, I need them to be able to produce return so that I can, that my equity holders and debt holders expect to be compensated for the risk that they're taking. Number 3, if we know what the expected return of the assets is, because we've backed it out from the expected return on bonds and equity, then we can get the risk of those assets. And the expected return for those assets is also referred to as the firm's cost of capital. So if we know what the expected return on the assets is, then we can back out the risk because the expected return of those assets is tied in with a certain level of risk, and we have some tools to back that out.